refinancing an investment property can be one of the most powerful financial strategies for real estate investors. Whether your goal is to lower monthly payments, access equity, or expand your portfolio, refinancing is a tool that can reshape the way your money works for you. In this video, we'll walk through the key refinancing strategies for investment properties, why they matter, and how you can use them to maximize returns while managing risks. Let's start with the basics. Refinancing simply means replacing your existing mortgage with a new one, usually with better terms. On an investment property, this can provide several opportunities. It's not just about getting a lower rate, but about unlocking capital and creating flexibility for your investment goals. One of the most common strategies is rate and term refinancing. This is when you refinance to secure a lower interest rate or to change the loan term. A lower rate means smaller monthly payments and more cash flow. Extending your loan term can also reduce payments, although it may increase the total interest paid over time. On the other hand, shortening your loan term helps you pay off the property faster and build equity more quickly. For investors who want predictable returns and stronger cash flow, this strategy can provide long-term stability. Another powerful strategy is cash-out refinancing. With this approach, you refinance for more than what you owe and take the difference as cash. That cash can then be used to reinvest, maybe for renovations, new acquisitions, or paying off higher interest debt. For example, if your property has appreciated in value, a cash-out refinance allows you to tap into that equity without selling. It essentially gives you a way to use your property like a financial engine, fueling your next investment move. A third approach is debt consolidation through refinancing. Many investors juggle multiple loans, perhaps on different properties, credit lines, or personal loans. Consolidating them into one refinanced mortgage can simplify repayment, lower overall interest, and stabilize your financial picture. This strategy can be especially useful if you want to streamline your portfolio and reduce administrative headaches. For some investors, refinancing is about shifting from an adjustable-rate mortgage to a fixed-rate mortgage. Adjustable loans often start with lower rates, but can become unpredictable and expensive as rates rise. Locking into a fixed-rate loan through refinancing provides stability and protects your cash flow against future market changes. If you plan to hold on to the property for the long term, this move can bring peace of mind and financial security. Another angle is portfolio growth through refinancing. Many investors use equity from one property to fund down payments on others. By refinancing strategically, you can multiply your investment reach without needing large amounts of new capital. This is often referred to as the snowball method in real estate. Using the gains from one property to fuel the purchase of the next, building momentum as you go. Refinancing can also serve as a risk management strategy. For example, if you anticipate vacancies, higher expenses, or economic downturns, refinancing to lower your payments and increase cash reserves can help you weather storms. Instead of waiting until problems arise, proactive refinancing ensures you're financially prepared for market fluctuations. Timing plays a critical role in refinancing. Interest rates, property values, and your credit profile all impact the outcome. Refinancing during a period of low rates or after your property has significantly appreciated can maximize the benefits. Likewise, keeping your credit score strong and maintaining good debt-to-income ratios increases your chances of qualifying for favorable terms. It's also important to consider costs. Refinancing isn't free. There are closing costs, appraisal fees, and sometimes prepayment penalties. The key is to calculate your break-even point. How long it will take for the savings or benefits from refinancing to outweigh the costs. If the math works in your favor, then refinancing can be a smart move. Investors should also be mindful of tax implications. The interest on a refinance loan for an investment property is generally tax-deductible, which can improve your bottom line. However, cash-out refinancing used for personal expenses may not qualify for the same benefits. Consulting a tax professional before refinancing can help you avoid costly surprises and optimize your financial outcome. One often overlooked strategy is refinancing to free up capital for renovations or improvements. Upgrading your property can increase rental income, improve tenant retention, and raise the overall value of the asset. By using refinance funds to improve the property, you not only increase cash flow, but also build long-term appreciation. International investors, or those with multiple properties, may also look at refinancing as a way to balance leverage. Too much debt on one property can increase risk, but redistributing that debt across properties through refinancing can create a healthier portfolio structure. It's about managing leverage wisely to grow sustainably. Ultimately, the best refinancing strategy depends on your goals. If you want to maximize cash flow, lowering rates or extending terms may be ideal. If your focus is growth, cash-out refinancing to acquire more properties might make sense. If stability is your priority, moving to a fixed rate could be the best decision. The key takeaway is that refinancing isn't a one-size-fits-all solution. It's a versatile financial tool that can adapt to your goals at different stages of your investing journey. By understanding the strategies available and aligning them with your objectives, you can make refinancing work for you, rather than just viewing it as a way to save a few dollars on interest. So, when should you start exploring refinancing options for your investment property? The answer is whenever you see a gap between your current loan structure and your financial goals. Maybe rates have dropped. Maybe your property has gained value. Or maybe your investment strategy has shifted. Those are the signals that it's time to reevaluate your financing and consider how a new loan could better serve your needs. Refinancing investment properties can unlock new opportunities, enhance cash flow, and support portfolio growth. But like any financial strategy, it requires careful planning, clear objectives, and a thorough understanding of both benefits and risks. If you approach refinancing strategically, it can become one of the most valuable tools in your investing toolkit.